Imagine walking into a casino. The doors swing open. The lights flash. Money seems to flow in every direction. That is how some people describe what happens when the Federal Reserve cuts interest rates. Every time borrowing costs drop, asset prices surge. Stocks rise. Real estate gets hotter. Even cryptocurrencies suddenly feel alive again. It feels like a moment where anyone can grab quick money. People start saying things like, "All you have to do is buy now and wait." They treat it like a sure bet, as if the Fed is handing out free chips at the table. But here's the question. Is it really that simple, or is the casino more dangerous than it looks? Think back to March 2020. The Fed slashed interest rates to zero. Within weeks, the stock market roared back after a sharp crash. Investors who bought quickly doubled their money within months. It felt effortless. But fast forward to 2022, the same Fed raised rates to fight inflation. That casino door slammed shut. And the same people who thought money would always pour in saw their portfolios cut in half. This is the cycle most people don't fully understand. The Fed opens the doors. Everyone rushes in. And then the doors close. Some leave with gains, others get trapped inside with losses. If you think about it, this cycle has repeated again and again. In 2008, during the financial crisis, rate cuts helped fuel one of the greatest stock market recoveries in history. In 2019, before the pandemic, the Fed cut rates to prevent a slowdown. In 2020, they cut again, and the rally that followed was breathtaking. But behind each of those moments were families, workers, and savers who didn't understand what was really happening. The passive path is about breaking down these confusing cycles in plain English, because once you see how the casino really works, you stop being just another player. You start thinking like the house. So let's keep going. Why do these interest rate cuts matter so much to the economy? And more importantly, what do they mean for your money? Interest rates are like the price of money. When that price goes down, everything tied to borrowing gets cheaper. Businesses can borrow more easily. Families can buy bigger homes. Governments can manage their debts with less pain. When the Fed cuts rates, it lowers the cost of loans across the board. A company that once paid millions in interest suddenly pays far less. That extra money shows up as profit on their balance sheet. And profits make stock prices climb. Think about a small business owner in Chicago. When interest rates are high, their loan to buy new equipment eats into every dollar they make. Cut those rates, and suddenly the business has room to hire more staff, expand, and grow. Now compare that to a giant company like Apple. Billions in debt are refinanced at lower rates. That single move adds billions in savings. Investors see stronger numbers, and the stock surges. But interest rate cuts don't just affect companies. They hit your personal life too. Mortgages drop in cost. Suddenly a home buyer can afford an extra bedroom or a better neighborhood. Student loans shrink a little, freeing up more spending money for graduates. Credit card rates edge lower, making debt slightly easier to carry. That's why the market reacts so quickly. Lower rates make the economy look healthier almost overnight. It feels like free money falling from the sky. But here's the catch. If it's so simple, why doesn't the Fed just cut rates forever? Why not keep the casino open all the time? Because every time rates fall, money gets cheaper. And when money is too cheap, bubbles form. Housing markets overheat. Stocks inflate beyond their real value. And sooner or later, the bubble bursts. This is the dangerous side of the cycle. It gives with one hand and takes with the other. So while interest rate cuts can make it seem like everyone is winning, the reality is more complicated. The real question isn't euro da, just how rates move, but who decides when they move and why. And that brings us to the next problem. If the Fed makes decisions based on data, what happens when the data itself cannot euro da be trusted? Governments know that numbers shape decisions. When the Federal Reserve says it reacts to economic data, the data becomes a weapon. If job numbers look strong, the Fed holds back on cutting rates. If growth looks weak, the Fed moves faster to lower them. That creates a powerful incentive for numbers to be polished, massaged, or even distorted. Imagine hearing that 200,000 jobs were created in a single month. It sounds like the economy is strong, but then months later the figure is quietly revised down to 20,000. The first number drives headlines and confidence. The correction barely gets noticed. This is not new. Governments all over the world have been caught spinning statistics. China has long been accused of inflating its GDP growth. In the United States, changes to how inflation is calculated over the decades have made comparisons difficult. Think about GDP. It is supposed to measure the value of everything a country produces. But if imports are restricted through tariffs, exports look stronger. On paper, GDP rises. In reality, families pay more at the store. A steak that cost $12 last year now costs $15. The economy looks bigger, but the household feels poorer. The same can happen with unemployment. Official unemployment may sit at 4%, but what if millions of part-time workers want full-time jobs? What if thousands stop looking altogether? They vanish from the count, and the number looks healthier than the reality on the ground. For an investor, this is critical. If you believe the headline numbers, you think the casino doors will stay closed a little longer. If the numbers are fake, you may be betting on the wrong outcome. This is why investors need to look at more than the headline. Compare jobless claims against consumer spending. Watch credit card delinquency rates. Check small business surveys instead of only Wall Street reports. The passive path is about seeing beyond the polished surface. Because the truth is not just in the official press release, it sits in the cracks, the contradictions, and the revisions. So why would a government risk its credibility by releasing numbers that don't add up? Because sometimes, survival depends on it, and that takes us straight into the heart of the debt problem. When a nation owes more than it can easily pay back, the pressure to bend reality becomes overwhelming. The United States carries a national debt of more than $30 trillion. That number is so large, it is hard to imagine. Think of it this way. If you earned $1 every second, it would take more than 1 million years to pay it off. Every year, the government borrows more to cover spending that exceeds tax revenue. And every year, the interest payments get larger. In fact, the cost of interest alone is now higher than the entire defense budget. That means the country spends more paying back old debt than it does on the military. For families, this is like maxing out every credit card and then struggling to make just the minimum payments. You are not reducing the balance, you are only trying to stay afloat. When interest rates rise, this burden gets even heavier. 1% higher rates add hundreds of billions of dollars in new costs. 2% higher, and the extra interest nearly equals all the money spent on public education. This is why the government has such a strong desire for lower rates. Each cut is like a giant relief valve. Billions saved instantly. It keeps the system running a little longer, but this relief comes at a cost. Cheaper money can encourage reckless spending. It delays tough decisions. It pushes the problem further into the future. The generational impact is real. Older generations benefited from decades of cheap debt and rising assets. Younger generations face the bill. They inherit higher taxes, slower growth, and fewer guarantees of security. This is where the pressure builds on the Federal Reserve. If it refuses to cut rates, the government struggles under its own weight. If it does cut rates, bubbles expand and future risks grow. The debt makes every decision more dangerous. There is no easy way out, and that's why debt is not just a government issue. It affects every saver, every worker, and every investor. So if the safest option government bond no longer behaves the way it should, what does that mean for anyone trying to protect their wealth? For decades, U.S. government bonds were seen as the safest place to store wealth. They paid steady interest, they carried the full backing of the government. They were the bedrock of pensions, insurance funds, and retirement accounts. But something has changed. In the past, when the Fed cut rates, bond prices rose. Investors made money holding treasuries. It was a simple rule. High rates meant lower bond prices. Lower rates meant higher bond prices. Today, that rule is broken. When rates were slashed recently, bond prices kept falling. Exchange-traded funds that held government bonds dropped 10% in just weeks. Instead of protecting wealth, bonds started eroding it. Imagine a teacher's pension fund. For years, it held treasuries to guarantee safe returns. But when both bond prices and the dollar fall at the same time, the fund suffers a double loss. The so-called safe asset turns into a trap. This double hit is not just numbers on a screen. It means pensions may be worth less when teachers retire. Insurance companies may struggle to pay out claims. Banks that hold too many treasuries may suddenly face insolvency. Investors now face a dilemma. If the asset that was once considered risk-free can lose value for years in a row, where do you turn for safety? Cash loses to inflation. Bonds lose to falling prices. Stocks rise and fall like a roller coaster. The illusion of safety is gone. And when that illusion breaks, people begin to question the entire system. So if bonds no longer serve as the anchor of stability, what does that mean for the banks built on top of them? Banks live and die by the value of their assets. For many of them, U.S. government bonds are the largest asset they hold. When those bonds fall in price, the foundation of the bank shakes. Think of it like a family whose wealth is tied up in a house. If the housing market crashes, their net worth collapses overnight. For banks, falling bond prices create the same kind of shock. This is exactly what happened with Silicon Valley Bank. They held long-term bonds that dropped in value when interest rates shifted. When depositors demanded their money back, the bank couldn't sell bonds fast enough without taking massive losses. The collapse rippled through the financial system, shaking confidence across the country. Even with FDIC insurance, ordinary savers felt the fear. Nobody wants to wonder if their bank will be the next to fall. And while most deposits are technically insured, the trust that holds the system together is fragile. This fragility doesn't stop at U.S. borders. Banks and insurers around the world also hold U.S. bonds. When those values drop, their balance sheets weaken. It becomes a global problem. The risk is a cycle. Bond values fall. Banks face losses. They sell more bonds to cover withdrawals. Prices fall further. Confidence erodes. And the cycle repeats. For everyday savers, this creates a difficult question. Where can you safely park your money? How much of your savings should stay in the bank? How much should be spread elsewhere? Bank failures are not just isolated events. They are signals that the old rules of safety are changing. And if even banks are vulnerable, what does that mean for the rest of the world that depends on the Federal Reserve's decisions? Every central bank in the world watches the Federal Reserve. When the Fed moves, the ripple spreads through every economy. If the Fed raises rates, money flows into the United States. Investors chase higher returns on U.S. bonds. Currencies in other countries weaken as dollars get pulled back home. If the Fed cuts rates, money looks for better opportunities elsewhere. Capital moves into Europe, Asia, or emerging markets. Currencies swing, interest rates abroad shift in response. Consider Canada. Mortgage rates there often rise or fall simply because of U.S. moves. A Canadian family buying a home can find their monthly payment changing because of a decision made in Washington. In Japan, ultra-low interest rates have lasted for decades. When the Fed raises rates sharply, Japanese investors move money into U.S. bonds. When the Fed cuts, that flow reverses, shaking Japan's currency. In Europe, central bankers often coordinate with the Fed to avoid currency wars. If one side cuts while the other holds steady, trade becomes unbalanced. Exports surge in one direction while imports collapse in the other. This is why the dollar remains at the center of global finance. Every move by the Fed reshapes the playing field worldwide. A simple decision on interest rates can raise grocery costs in Mexico, housing costs in Canada, or energy costs in Germany. But there is a growing question. What happens if trust in the dollar itself begins to erode? What if other nations decide the casino isn't fair and they want out of the game? Inflation is the quiet tax that touches every wallet. When prices rise, each dollar buys less. Families notice it first at the grocery store. Milk, bread, and eggs climb higher. A weekly trip that once cost $100 now costs $120. Trade policy can fuel this without people realizing it. When tariffs are added to imported goods, the government's numbers may show higher GDP, but the reality on the ground is more expensive products. Imported electronics, cars, and clothing all carry higher price tags. This distortion makes the economy look stronger on paper. Exports rise. Imports fall. GDP ticks up. But households pay the price in higher living costs. Real wages tell the true story. If your paycheck rises by 3%, but inflation eats away 5%, you are poorer, not richer. The math is simple. Your money stretches less, even though the official data suggests growth. Look at everyday costs. Health insurance premiums climb faster than wages. College tuition continues to outpace inflation. Rent in many cities absorbs half a paycheck. For a middle-class family, these pressures mean saving becomes harder. Emergencies force more borrowing. Debt balances rise. And the cycle feeds itself. This is why investors cannot rely only on official reports. They need to track what's happening in real life. What are consumers spending? Are defaults on credit cards rising? Are households taking on more debt to maintain the same lifestyle? Inflation and trade policy shift the foundation of financial security. They decide who gets squeezed and who survives. The key question is simple. If the official numbers are polished to look good and the costs of living keep climbing, where can opportunity still be found in all this chaos? Many investors believe that if they just study hard enough, they can predict every market move. They read reports, follow headlines, and track the Fed's every word. But the truth is that retail investors rarely win by chasing news. Big institutions have access to faster information and deeper networks. They move billions before the average person even reads the headline. By the time most small investors act, the opportunity is already gone. This is why investing based on daily news feels like gambling. You may guess right once or twice, but over time the odds are against you. The house has the edge. The better path is building a strategy that does not depend on being perfect. Set rules for when to buy, when to sell, and how much risk to take. Focus on probabilities instead of predictions. Think about two different mindsets. The casino player believes they can win big on one lucky roll. The house owner knows that small, steady advantages add up over time. The passive path encourages you to think like the house. An example is dollar cost averaging. Instead of guessing the perfect moment, you invest a set amount each month. Some months you buy at higher prices. Some months you buy lower. Over time, the average smooths out risk and builds real wealth. Another example is setting exit rules. If an investment drops by 10%, you decide in advance whether to cut losses or hold. This prevents panic in the moment. Building a plan means accepting that you will not win every time. Losses are part of the process. The goal is simple. Lose small when you are wrong. Win big when you are right. This way, you stop playing the Fed's game and start playing your own. But there is still the bigger challenge. How do you create a plan that holds steady when the Fed is unpredictable and markets swing wildly? Smart investing in uncertain times starts with spreading risk. Diversification protects you when one asset fails. It means not putting all your money in one stock, one sector, or even one country. Consider a teacher investing $200 each month. If all of it goes into US tech stocks, the portfolio rises fast during booms, but collapses during downturns. If that same money is split across global stocks, bonds, and real estate, the ride is smoother. Dollar cost averaging makes this even stronger. Investing the same amount every month builds discipline. You buy more when prices are low and fewer shares when prices are high. Over time, it keeps emotions from dictating decisions. Holding some cash also has value. Cash gives flexibility. When markets crash, those with reserves can buy while others are forced to sell. This is not wasted money. It is buying power waiting for opportunity. Real estate cycles show another lesson. In North America, housing booms often follow periods of low interest rates. Families rush to lock in mortgages. Prices climb until affordability breaks. Then the cycle cools, and opportunities appear for those who waited with patience. The key is not chasing every headline or panic move. It is creating a system that can handle both storms and calm waters. That way, you don't need to predict the future. You only need to prepare for it. But even with the right strategies in place, another question remains. How do you keep your mindset steady when fear and greed take over the market? Wealth is not only built with money, it is built with habits. The strongest portfolios often belong to those who stayed calm when others panicked. Discipline means sticking to your plan even when markets swing wildly. Patience means holding through downturns and giving investments time to grow. Skepticism means questioning the easy promises that often lead to losses. Warren Buffett is famous for waiting years before acting. He lets opportunities come to him instead of chasing them. That patience is a lesson for every investor. Think about the average worker who kept buying into their retirement plan during the 2008 crash. When markets recovered, their steady contributions turned into strong gains. Those who pulled out at the bottom missed the rebound. This is why mindset matters as much as math. The ability to control fear and greed is a real financial advantage. It allows you to keep building wealth while others get shaken out of the game. The passive path is about making steady progress, not chasing shortcuts. It is about creating habits that build freedom over decades, not just weeks. You don't need Wall Street secrets to win. You need clarity, consistency, and courage to stick to your path. And this brings us to the final step. What lessons can you take away today and put into practice immediately? Here are the lessons to carry forward. Do not rely only on headlines or government reports. Look at the real economy around you. Watch consumer spending, debt levels, and default rates. Numbers on a chart mean little without context. Build a strategy that does not depend on predicting every move. Set rules for how much to invest, when to buy, and when to exit. Make sure losses are small and wins are allowed to grow. Diversify your wealth, spread it across stocks, bonds, real estate, and even different countries. This protects you when one market falters. Keep cash reserves. Cash is not wasted. It is fuel for opportunity when prices fall. Adopt the right mindset. Discipline, patience, and skepticism are tools as valuable as dollars. Stay steady when others panic. Stay cautious when others get greedy. Wealth is not built in a single trade or a single year. It is built over time, step by step. That is the heart of the passive path. If this message helps you see money differently, share it. If you want to learn more, subscribe to The Passive Path and join the conversation. Leave a comment with your own experience and like this video to keep it saved for later. The economy will always swing. The Fed will always open and close its casino doors. But your habits, your plan, and your mindset decide your future. Stay steady, stay prepared, and keep walking. The Passive Path, thank you for watching, and I'll see you in the next video.